I guess I shouldn't have taken a shower this morning.
And in three, two, one. Hello and welcome to another episode of the Investment Property Income Podcast. I am your host, Jeff Eady, as usual. Joining me today is the pirate to my parrot, Mr. Jonathan Tilger. Jonathan, how are you today?
I'm great. How about yourself, Jeff?
I am fantastic, sir. That just means that I stand on your shoulders and talk way too much, sir. Uh, Today we have a very special guest, and as always, I like to get the first intro at least close to right. So I do try and read these as they're given to me, but I'm not great at following rules or coloring inside the lines. But today we have one of the principals, or the principal. Is it multiple principals? There are three.
Yeah,
yes,
one of three.
Yes, one of three. At VanWest Partners, a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers and other opportunistic real estate throughout the United States. VanWest has established a track record with over 195 million in real estate assets, and the partner's success is driven by a commitment to delivering an expertly executed, adaptable strategy with an institutional investment approach. Man, that's a lot of words. Please welcome to the show, Mr. Jacob Vanderslice. Jacob, how are you today?
I'm doing great. Thanks for having us on today, guys. We appreciate it.
Oh, super excited. Super excited. It's funny. You and I were already talking that we have a friend in common, and it's really cool to see that we can span the borders internationally, as we were just saying, that, Canadians and Americans connecting. It's, one big happy world. So
Agreed.
Jacob, why don't you start out by telling us a little bit about yourself and VanWest?
Yeah, I grew up in Arvada, a suburb just northwest of Denver, and I was in the fire service for a couple of years when I got out of college, and I started doing fix and flips on my days off and got busy doing that. And I quit my fire job about 15, 16 years ago, and I've been full-time self-employed in real estate ever since. One of my partners, Aaron Westfall, I went back to junior high with him. He quit his software engineering job at Qualcomm in about 2009 and joined me full-time. And our third partner, Wade Buxton, used to work for us about 11 or 12 years ago. And that was the last time he got paid. And eventually, over time, he became a partner. And Wade is very proud. He's the only one of the three of us who has never gotten a W-2 in his entire career. So I had one for a couple of years, and so did Aaron, but Wade remains W-2 free. So yeah, we mainly focused on buy, fix, and sell residential deals for many years in our careers. We've done over 1,000 fix and flips all over the country, mainly in Denver. A lot of buy, fix, and sell, buy and hold. Done some townhome development along the way. And then in 2013, we got into commercial real estate, and we started doing adaptive reuse retail around Denver, which is essentially converting 100-year-old plus old brick bomb shelter warehouses into multi-tenant experience-based retail concepts. We've done a number of breweries and restaurants. We haven't done them, we've leased to them rather. Held on to some of those projects and sold others. And that was really the only challenging part of our business during 2020. We obviously, restaurants and breweries got pretty beat up, but every one of our tenants but one made it through. So that's good. And then in 2015, we got into self-storage. And we had studied the asset class for a number of years. And we like the historic recession resistant aspect of it. Typically, it performs well during downturns, and it performs well during buoyant times as well. So we started off doing ground up development and self-storage. We built a number of projects in Denver with a programmatic joint venture with some high net worth partners. And then we expanded into the Midwest market in Milwaukee specifically. We started doing deals out there, and then kind of continued buying in the Midwest and the Southeast. So through today, we've got 33 properties, Midwest and Southeast. In the last couple of years, we've mainly focused on value add existing deals that are just undermanaged, underperforming for whatever reason. Sometimes they don't have a website, rates are below market, expense loads are high. And most of our value creation in those asset types is from management, and less so on the capital improvement side. Next year, we're going to continue that strategy, but we're also going to get back into development. We're seeing opportunity now in the development space we weren't seeing for a while. So we'll get back into building, but our main focus, 95% plus of our time, is on self-storage, with the exception of a little building we just bought in Denver to open a liquor store in. So nice. not sure why we're doing that, but if someone asks, our response is because it's going to be fun and because we can. So, yeah.
That
So-
diversification, isn't that what they call it?
Exactly. Yeah. I'm not sure what the ROI on time is going to be for that deal, but the ROI on fun might be pretty high. Yeah.
So I want to back that up a little bit. You covered a whole lot of ground in that, but the thing I find most interesting is that you were a firefighter to begin with.
Yeah, I volunteered in college and I got a career job out of college. My now wife broke up with me and decided to be a fireman. So did that for a couple of years. It was an absolute blast. I definitely miss it, but I think just the someone telling you where to be with a set schedule and it just kind of in the end wasn't for me. So I wanted to be on the entrepreneurial side of things, and there I went. And here I remain and will remain.
So let's talk about that transition. How long did it take you from your first fix and flip to transition over to being an entrepreneur?
It was a couple of years. I was kind of dabbling on the side, and like everything we've done in our real estate careers, we've learned by failing, and we don't read this. I really don't think if you want to learn real estate, you can't read it in a book or learn on a podcast or in a seminar. You have to go out and do a deal. And hopefully your first deal goes okay, but if it doesn't, you learn. And I like to say that every year we get a little less stupid. We don't so much know what to do, but we really know what not to do. So yeah, just kind of learning how to identify value, acquire properties, operate them, run construction, whether it's a fix and flip or a $20 million development project. And just mitigate the downside and have a good base case upside scenario. You can apply those principles to a single family home or a giant apartment building or a self-storage facility.
And how many places did you go through before you made the decision? All right, now it's time to do this full time.
I probably had like 4 or 5 rentals on the side and just wanted to go out and do it. So I did.
That's fair.
Yeah.
And you started VanWest immediately at that point, or did that take a little
Yeah,
while?
VanWest kind of evolved. So my last name is obviously Vanderslice, and my partners, my first partner, Aaron Westfall, is Westfall, so VanWest. And then we couldn't fit Wade Buxton in VanWest, so he's an equal partner, but have his name in there, but he's fine with that. Yeah.
And what was it like raising your first fund? How did that come about?
Well, we historically have done single asset syndications in residential development, retail projects, and self-storage. And we pivoted to a fund structure for a variety of reasons. One of the reasons we like a fund versus a single asset syndication, and both work, and we continue to do both. But the fund structure we like because it's one set of documents, it's one set of terms. And we like the geographic diversification that a multi-property portfolio offers versus one deal. Inevitably, let's say you have 10 properties, maybe 2 are behind forecast, 6 are on forecast, and 2 are ahead. They all kind of balance each other out. And then next quarter that might shift. A deal behind forecast might go down forecast, and then vice versa. And if you end up discovering you have a dog in the fund in a couple of years, a deal is just not performing well, ideally the other 9 kind of shore that one up. So it's kind of a better diversification strategy in terms of geography and cash flow. So we do both, but the fund structure has been really good to us.
No, you know what? That's really important is diversification within an asset class. Up here in Canada, we have something called a mortgage investment corporation, which is the debt side of what a REIT would do. And I find those are in my opinion, I have to definitely make that disclaimer. I find they're a really good way for people who don't understand real estate to at least get started, because you can diversify. You don't have to do the management yourself. You're not getting the calls and the landlord stuff. And exactly what you said, if something takes a dive, it doesn't kill you. You feel it, yep, but it doesn't kill you. And that's a massive thing, is learning how to take losses in this business.
Yeah, in our prior fund, it turned out to be a good deal, but one really important thing in self-storage, kind of like multifamily, is making sure you get your property tax accrual calculations correct. If you don't accrue correctly for increased property taxes, that's a dollar for dollar hit on your bottom line. And we bought a deal in Illinois, which is not a property tax friendly state. And this deal straddled a township, and we missed an extra property tax assessment. And we probably would have missed this 10 out of 10 times if we bought it again. So the deal was about $5 million. And we missed the property tax assessment calculation by probably $60,000, $70,000. It's a big number. And we're protesting it. It'll probably go down. But that property, thankfully, has performed really well, and we're 100% economic occupancy. But because it's part of a fund, that miss is not affecting the fund very much. It's not ideal, but because that's part of a 9-property portfolio, the kick in the teeth is not what it would be if it was a single asset syndication.
Yeah,
I gather with.
Sorry, go ahead, Jason.
I gather with the single asset, you're having to now, when you approach investors, you got to sell them on that single asset one at a time. So it'd be
administratively
a lot of work.
Yeah. I mean, raising capital is about educating and not so much pitching. And if you're doing single asset syndications over and over again, that's a lot of education on individual deals. And we still will educate our capital base and our partners on our fund deals, but they're part of the fund and they get the strategy. Versus a one-off deal, which we're actually doing one in late December. That'll kind of be a one-off syndication between Fund 2 and Fund 3. But you're right, administratively, it's another PPM, another set of documentation, another tax return, another set of financials, versus a fund is just one set.
And I'm assuming once if you were to dispose of that asset, suddenly all those investors, to get them into something else, you'd have to go through the whole process again, versus with the fund, so you just move the asset and replace it with something else. The money's still there.
Yeah, exactly. I mean, one of the disadvantages of a fund is it's more of a discretionary pool that investors might have a hard time sometimes with that. So they know we're buying self-storage, of course, but we may buy a deal in Wisconsin, and they don't want to be in Wisconsin for whatever reason. And we'll certainly listen to that. But that's one problem with the fund. It's a little more of a open-ended kind of blind pool strategy versus if they're investing in a single asset syndication, they know exactly what they're getting into. It's a specific deal. It's in this market. They could go drive by it if they wanted to. They could drive by all the deals, I guess. But if they're all over the country, that's a little bit tougher. So yeah, there's disadvantages and advantages to both for sure.
So we kind of covered this before we started rolling here, but can you talk about like who your investor is? Because this isn't open just to everybody.
Yeah, well, it's open to everybody if you're accredited, and accredited means you make $200,000 a year if you're single, or $300,000 a year if you're married, or your net worth is $1 million outside your primary residence. So one of those two requirements, if you meet one of those two, you're considered accredited. So that's really the only limitation on our investors. We have people anywhere from CEOs of publicly traded companies to horse jockeys, to attorneys, to dentists, to doctors, entrepreneurs, other real estate operators and investors who just want exposure to self-storage but don't want to go out and buy a deal themselves. So yeah, we have a pretty wide band of folks that are our partners in our funds and syndications.
Sorry, I got to go back to the horse jockeys. That's just cool.
Yeah, that's right. Well, he's okay. I got to be fair here. He is not signed up yet, but he's going to. So I'm being a little brokery there. He will be an investor, but he's not technically in yet.
So you drop that one just as a sort of a foreshadowing.
That's right. It's a better story in terms of the cross section of folks that we work with. Yeah.
ABC, always be closing.
That's right.
So how do regular people get involved in something like this?
Well, first of all, you talked about diversification earlier. And I think as people are exploring investing in private real estate vehicles, whether they're funds or syndications, I think diversification across sponsors and fund managers is as important, if not more important, as diversification across asset classes. I think if someone wants to allocate whatever 500 grand to self-storage, they would be well served to drop 1 to 150 with multiple sponsors. Even though it's all in the same asset class, I think just working with good managers and kind of spreading your risk across different shops is a good strategy. As far as how people participate, the process is pretty simple. We have an online investor portal. They answer some questions in our investor portal. We typically do that on a Zoom call with them. Sometimes they do it on their own, but they have the option to do either one. Once they complete the portal, they get a DocuSign document pushed to their inbox, which is kind of another round of questions that simply substantiate accreditation and risk disclosures. They sign, we countersign, then we coordinate funding. Our capital structure is fairly simple. We have an 8% accumulating preferred return. And for those of us listening who don't know what that is, it's a common element of a fund or syndication that's designed to get investors kind of the first round of yield before anything else happens. And then every distribution above and beyond 8% goes to return investor capital. So with our structure, in short, 100% of the distributions the fund makes go to investors until pref is paid current and until a complete return of capital. After that, there's a split between us and the investors. And we have 3 different share classes. If folks invest under 500K, it's 70-30 in their favor. Over 500 is 75-25, and over $1 million is 80-20. So that's our waterfall structure. It's fairly simplistic. There's a lot of structures out there that have IRR waterfalls. So, once you get over a 15% IRR, there's better economics for the sponsor, and then maybe that increases once you get over 20. Ours is just a straight line with no catch up, 70-30 to 80-20 after pref and after return of capital.
And what's your timeline on each of these funds?
So one of the many mistakes we've made in our real estate careers is being overly transactional. And by that, I mean buying, making better, and selling too often and too quickly. And when that's your strategy, it's not a bad strategy necessarily, but the problems with it are several. One is it's very tax inefficient. So you have depreciation, recapture, and you have capital gains. Secondly, you have a liquidity event. You get a bunch of money into your bank account, and you're no longer making a return on that cash. And you have to take a new round of risk to redeploy that into some sort of new vehicle, whether it's, if you're a real estate person, whatever, multifamily, office, industrial, self-storage. So with that being said, we designed our funds to be more of a longer term cash flow play with capital appreciation, of course. We're targeting a blended 7+ year hold. It could go up to 10 years. It could be as little as maybe 5 or 6. And the reason there's kind of a range on it, we don't want to be forced to sell into a market that's not good to sell into. So let's say we committed to selling everything off in 5 years. And let's say year 5 comes and our portfolio is creating great cash flow. Everybody's happy. They're getting above market rates of return on a current basis, but for whatever reason, the value of the portfolio has declined. We don't want to be forced to sell into an environment that's not ideal to sell into. So we'll monetize when the time is appropriate, and monetizing the portfolio may not necessarily come in the form of a fee simple sale. It could be a recapitalization with a new round of equity and give investors the option to either stay in at a stepped up tax-free basis or have a liquidity event. It could be a refinance after value is created, replacing investor equity with bank debt, paying back capital accounts. And it could be a portfolio-wide sale with some hopefully cap rate compression to either institutional or private equity buyers. So we're looking at our exit from a variety of different scenarios, but we're underwriting to a blended 7-year hold in our modeling.
Wow, you said a lot there.
Yeah,
sounds like you know your stuff.
Yeah, it's. I mean, you have to show an exit. You can't just say, "Hey, invest with us. Someday we'll sell. Who knows?" So you have to underwrite to an exit, but we are not great sellers. Selling. I mean, sometimes it makes sense, and sometimes there's a price that makes sense that you just can't say no to. But we have come to realize and believe that real wealth creation in real estate is recurring, durable revenue streams that grow over time. And because commercial real estate trades on a multiple of the income stream it produces, if you're growing that income stream, by default, the value of your asset base is increasing.
Mm-hmm. It's really interesting because forgive me for saying this, you're talking in very institutional language, and a lot of the people that listen to what we do maybe wouldn't quite understand some of the terminology, but if I can decipher it a little bit, you're really saying some very sound strategies for all, across the board for real estate. Don't fix and flip it, hold the thing, use the equity, buy another one, or partner up with people, buy another one so that your asset base grows. And now you don't have to worry as much about your monthly, and it just keeps going. You can build on that.
Yeah. To be very clear, I'm just a dumb real estate guy. I happen to know some of these institutional terms, but I mean, our thesis is buy it right, make it better, and operate it and grow your income streams over time. And everything else takes care of itself.
That's pretty simple. I like that.
A lot of the old rich folks that we know that have become wealthy from real estate. How'd you do it? Well, I went down there 40 years ago and I bought it and I never sold it.
Yeah, and
Yeah.
I mean, as you say, you get money as it appreciates in value. You've got additional wealth in there, and you can decide, well, do you sell it? Do you or do you just take that, maybe upgrade it a little bit, which can increase your cash flow hugely on the property.
Yeah, and heaven forbid you create a scenario years down the road where you can refinance a substantial portion, if not all, of the equity back out of the fund and still continue making distributions. If that happens, I think the incentive to sell diminishes a lot because everyone has been completely de-risked. Their money's out and they're still getting paid.
Yeah.
So again,
Sounds
to be
terrible.
clear, we're underwriting a sale event, and we believe our underwriting on that sale event and our valuations are fairly conservative. But we want to structure our deals in a manner where we can make an above market return without relying on a 2 or 3 year low cap rate exit.
So I'm just writing down questions because there's some really great stuff coming up here at both, we'll say, an educated real estate investor level and the beginner. Can you talk about how you underwrite something you're going to buy?
Yeah, we can kind of talk generally just in commercial real estate, and we can drill down a little bit further on self-storage. But whether you're buying an apartment building or an industrial building, whatever the case might be, your game is to grow that income stream or the net operating income on that property over time to a cap rate that is higher than market. So for those of us who aren't familiar with cap rates or capitalization rates are kind of the metric that commercial real estate's valued. And a lower cap rate, meaning net operating income divided by cost, implies that that property is more valuable and a lower risk. So an Amazon industrial deal, for example, with a 10-year lease might trade at a 4% cap rate. In other words, an investor might pay a 4% return to buy that very low risk deal. And the opposite side is you might have a suburban kind of busted retail strip mall with a nail salon and payday lending and buy the scoop food. That might trade at a 9% cap rate because the tenant base is inherently riskier. The chances of them blowing out is a little bit higher. Your buyer pool maybe isn't as robust as the buyer pool for the Amazon industrial deal. So the game is to buy properties, whether you're buying at a 0 cap or a 2 or a 4 cap, it doesn't really matter what you're buying at to a degree, and growing that cap rate over time to say an 8 cap, for example. And maybe the market eventually says that's worth a 6 cap. And again, there's an inverse relationship between cap rates and values. So as you grow your cap rate over time or your yield on cost over time, you've created value in that property. And not only have you increased your cash flow, but your balance sheet is increased as well, because now it's worth more than you're in it for. So in self-storage specifically, we approach it the same way. Underwriting self-storage is a little bit different than, say, back to the Amazon example, because our revenue streams are all month to month. So our customer base is all 30-day leases. They're all month to month. And the revenue streams are very granular. So we're relying on thousands of people to pay us $50 to $250 a month. Whereas I keep hammering on the Amazon example, but maybe Amazon's paying you 40 or 50 grand a month. It's a very low cap rate, so you paid a lot for the property, but you can forecast out that income stream, assuming they pay for the entirety of their lease, probably within a couple $100 every year, I would guess. In self-storage, the forecasting is a little more complicated because, again, month-to-month leases, you have seasonality. The peaks and troughs of the Milwaukee market, for example, in the winter and summer are very different than they are in Pensacola, Florida. So you have to be able to underwrite and kind of normalize the peaks and troughs of those revenue streams and kind of changing consumer demand throughout the year. But we like it because we're relying, again, on a lot of people to pay us a little bit of money. And the chances that a big chunk of them roll over at the same time are very low. And we can also very dynamically manage our revenue. So we can respond real time to supply and demand changes, both within a submarket and within a facility. So for example, let's say we have a 10 by 10 unit type, it's really full. We can increase rates on those customers to by maybe call it $10 a month, and nobody will probably move out because we're still cheaper than the competitors. Nobody wants to move on the weekend. And $10 a month may not seem like a lot, but you do that on 500 units, you annualize that times 12 and you put a cap rate on it, you've created a lot of value. And likewise, if we have a 5x5 unit type that's lighter on occupancy, we can drop our rates below market to drive up unit occupancy faster, and then dynamically manage that revenue as we kind of march towards stabilization. So those are a few reasons why we like the asset class. But with all that being said, it's a little more difficult to forecast because you're looking at these revenue streams, years down the road.
So who operates these properties for you?
We self-manage our portfolio, and that's not because we necessarily wanted to. We used to third party everything to some of the national REITs. And we realized over time that even though these guys are best in class and they have their algorithms and their marketing machine, we realized over time that they don't care like we do. And our interests to a degree were misaligned. And there's a lot of ancillary revenue streams in self-storage. We won't go too far into this, but one of them is customer insurance. So believe it or not, in self-storage, the owner is not responsible for the contents of the units. It says that in the lease. So we require our customers to provide either a proof of coverage on their homeowner's policy, or we sell them a plan. We pay $2 a month for the plan to our carrier, and we sell it for $10 to $15 a month. So a number of the national REITs keep all the insurance revenue. And between insurance, late fees, and one-time administrative fees, which is a fee somebody pays when they move in, those three income streams account for 8% of our top line revenue. And I think tenant insurance is about 3 or 4% of that, or almost half. So we were giving that away before, not to mention these guys just are not looking at the books like we are. They're not looking at the operating expenses like we are. We had a snow removal budget, for example, on 2 properties in Denver. One had a very small parking lot and one had a very large one. And the snow removal budget was the same, which is just another example of them just not looking at it like an owner would. So because of that, we formed our own management platform about 3 years ago, and took a number of properties back from the REITs that we now self-manage, and we've self-managed everything we've bought since then.
You must spend a lot of time traveling.
Yeah, we're on the road a lot.
Yeah.
Yeah.
Wow.
Yeah, we were in Georgia last week. My partner's in Austin today. So yeah, we travel a fair amount for sure.
And how affected by 2020 was the storage world?
As awful as 2020 was, it was actually, it really increased storage demand quite a bit, especially starting kind of towards the later part of the year and going into 2021. Not just us, but our portfolio and a lot of the operators we know are seeing record revenue growth, record occupancy growth. We closed our prior fund in August of 20. So our first full quarter of operations was Q4 of 20. That was the first quarter we owned all of our deals that the fund would buy. And our net operating income from Q4 to Q3 of 2021 has increased by like 43%. So it's been just explosive growth. The big question is, how long will that sustain? Is this a systemic shift in self-storage consumer demand, or is it a blip on the radar that's going to kind of normalize eventually? We're not seeing any indications of a slowing yet, but we're definitely being cautious on the deals that we're buying, that we bought and are going to continue to buy.
What made you make that shift the first time over to storage? Because it's an interesting area for me.
Yeah, we had looked at it for a while, and one of my partners, Wade Buxton, he was our self-storage experience in our shop, and by experience I mean he helped his parents build one in California when he was in high school. Okay. So yeah, that was our track record. But he knew a little bit about it. He had done a fair amount of commercial mortgage-backed security underwriting, kind of moonlighting for self-storage loans. So he knew the asset class pretty well. And he's like, we should really look into this. And we studied it for a while. And as I mentioned earlier, the best way to learn something is to go out and do it and figure it out. And that's what we did.
Did you ever have that analysis paralysis where you didn't make those decisions quickly and regretted it?
Well, thankfully, I'm not very afflicted by that. I'm kind of the shiny object, go guy. Wade's kind of in the middle, and our other partner, Aaron Westfall, is more of the analysis paralysis guy. Sometimes can't see the forest through the trees, but that's why he's our CFO and controller and IT guy. He's a big detail guy. The last 5 years or so, Probably longer. There are a lot of deals that we've said, man, we should have bought that. We should have bought that. We should have bought that. Someday, and this day hasn't come yet, but someday we're going to say, man, I'm glad we didn't buy that deal. At some point that's going to shift, and we thought it would shift last year. We thought the world was going to go on sale. We were going to just clean up everything at a discount. And other than some retail, office, and some hospitality deals, that did not happen. In fact, as we all know, it was the opposite.
Yeah, it's kind of crazy because you're not the only guy I've talked to that thought that was going to happen. And there was all this opportunistic money sitting out there waiting, and
Yep.
they had no place to place it. They've all been forced to rethink their strategies in the last 6-8 months.
Yeah, and I think that's why largely why cap rates have compressed so much in some of the darling asset classes like multifamily, industrial, self-storage. Cap rates have gone way down, which, as we covered earlier, that means values have gone way up.
Mhm.
How long that will continue, I'm not sure. Every time we forecast something, we're wrong.
Obviously, contributing to that factor is just the whole interest rate environment, which has been silly.
Yeah, agreed. I mean, you have a very low cost of capital. You have a massive amount of wealth on the streets that wants to be in hard assets. And some of the trades we see are just astounding. Like, how can you pay a 3 cap for something and make that make sense? But people do.
Yeah.
Well, they're tired. You mentioned it before. Having undeployed assets is worse than having a low yield asset.
Yeah. Yeah.
There's so many people just sitting with money in their bank accounts. And I know for some of the folks who listen to this who are beginning, it sounds ridiculous, but there is a ton of money out there. If you get good at educating, exactly like you said, educating your client base, it's not that hard to attract that money right now when it's sitting there doing nothing.
Yep. And today, I mean, if you're sitting on $1 million for the next year, arguably that $1 million in cash could be worth $950 in a year from now, or less.
Absolutely.
Potentially. Yeah.
Absolutely.
Yeah. Cash. We always say cash is king. Everyone says that in real estate, but these days, I don't know if that's so much the case anymore.
Well, we're seeing inflation rates near the 4% mark right now in Canada, and that's an awful lot of money lost on that capital.
Yep.
Especially when you see like I don't know, what do you guys have? CDs, I think, are the same as GICs up here. And one I saw the other day is like, 1.86%. It's like, oh good, you're only losing like 2.5. You still got to pay taxes on that.
Yes, exactly.
It's kind of crazy.
I'm biased, but I and many other people, probably you guys included, believe that real estate is a great inflation hedge. You're tying up a hard asset with a long-term loan that's not going to mature anytime soon, with a low cost of capital. And we think that's a good spot to be in this environment.
Sorry, go ahead.
Not to mention, it's also something that produces a cash flow that does not affect the value of the asset. Actually, the cash flow increases the value of the asset.
It does. Yeah. We said cash is king earlier, and we think cash flow is king.
Yes.
Yeah. I would agree with that. It's, you know what, the other thing is like a lot of people started running into assets like gold and silver when everything started looking squirrely in 2020. But I think the people who were just before all of that in real estate really benefited from, I know in our area, we saw 40% jumps in single family homes.
This rate of appreciation is untenable. And then it keeps going. So apparently it's not untenable.
Do you think there's going to be a correction in that soon?
I don't know. I mean, specifically in our Denver market, our inventory is so historically low. You would have to have an exponential increase in housing inventory to start to see a major decline in pricing.
Mm-hmm.
And, we're seeing, I don't want to say a softening, but just a less red hot. Maybe if a deal is priced right, instead of having 15 or 20 offers in the first weekend, now it has 5.
Yeah.
And instead of going for 50 grand over ask, maybe it's going 25 over. So it's just a little less hot, but that could be more of a seasonal thing. Obviously, Q4 real estate market slows down a little bit, but 2022 will be interesting for sure.
So what you're saying is it's not just our market we're seeing here that's seeing that same thing. It's happening all over the place.
No, it's across North America. Every operator I talk to, no matter what market you're in, they're seeing the exact same things. Even in Australia, we've got some investors in Australia, and down there, the investment strategy is completely an appreciation play. There is no cash flow in that market. In fact, people will feed their portfolios. They will negative cash flow, but the value of the portfolio will go up, 15, 20% every year. So they'll feed it a couple $100,000 every year, but they'll just watch it go up in value. So yeah, it's across the world right now.
That's so crazy. That's so crazy. One of the things I noticed, I believe it was on your website. No, actually, I think it was on the one pager that we were sent, is investing through IRAs. So you guys can do self-directed IRAs up there. For our Canadian listeners. That's pretty much exactly the same as a tax-free savings account. But you guys allow that to happen through your funds?
We do. Like anything, there's advantages and disadvantages to investing in a syndication with an IRA versus with cash. The main disadvantage to it are really two things. One, you're not able to enjoy as much of the depreciation as you would by investing with cash. Our depreciation all flows through to investors. And with a cash investment, what that translates to is if there's a loss from depreciation, even though you're positive cash flow, you can use that passive loss to offset other passive gains. With a retirement account, you can't really do that. And the other downside to IRA investing in a vehicle that uses leverage is there are some tax implications that could be created on the component of the asset base that uses leverage. We won't go too far into that, but it's definitely something that people need to understand before investing. With that being said, though, we have millions of dollars of IRA capital in our funds and syndications. So it's a good vehicle to use. It's kind of, to a degree, house money, right? And if you don't need it for a while, it's a good place to park.
Yeah. No, definitely. Do you do 501k as well?
401ks? Yeah, we do.
Sorry, 401k.
Yeah,
Up here,
right.
it's a Rrsp 401k. I remember the first time I heard somebody say that, and it was like everybody's laughing at the joke. I'm like, I have no idea what that is.
I would say over half of our investors are individual accounts that are cash. And then maybe the other half, it's probably broken into thirds between trusts, IRAs, and LLCs. Those are kind of the three common non-personal vehicles people use to invest through.
Well, I think it's massively important for people who have access to their pension funds and self-directed, because a lot of times it's just getting put into whatever a company wants to put it into, and they have no control whatsoever. So you actually being able to vet your, you know what, that to me, that's a very important point, because a lot of people don't understand the tax structures around the difference between an RSP or 401k and an IRA/TFSA. They're pretty much exactly the same thing. It's a bank account with a tax structure attached to it. But a lot of times when they do sign up for these at wherever they work or whatever financial advisor sold them on it, they look at it 10 years later and there's been almost no growth. And it gets eaten up in fees and all of these things. So what's different investing in a fund like yours as opposed to just letting it go with a financial advisor that's putting it in a mutual fund?
Yeah, well, whether you're investing with an IRA or with cash, one of the main disadvantages to investing in a private real estate vehicle like a fund or syndication is you have a lack of liquidity. So if you want to get out of your mutual fund, you call your guy up and he sells your stocks and you get a wire transfer to your Schwab account, right? In private real estate, if you want to get out, we do have a mechanism where we can offer the shares for sale to other investors in the fund. No one's ever asked to do that, and people shouldn't rely on that as a source of liquidity. That's the main disadvantage, though. But the advantage, whether you're investing with a retirement account or not, is you have current yield, which is arguably fairly predictable and quantifiable. Values in 7 years from now are not, but yield is a little more easily forecasted. So you have cash flow and you have capital appreciation too. So if you're investing through a retirement account and the value of that fund's asset base increases substantially over time and eventually it's sold, those gains would largely be tax-free. Mm-hmm. And it would probably beat the return of an index fund held over the same period. Yeah,
that's brilliant to me. I love the idea of investing through registered funds, depending on, of course, how you're set up, because you did mention flow through. That's an interesting strategy that not many people are aware of. Can you elaborate on that a little bit?
You're talking about depreciation?
Yeah.
Yeah. So standard building depreciation in the States is a really nice tax vehicle because it allows investors to not incur tax liability on certain cash flows over time. So let's say you're getting an 8% cash on cash return in the first couple of years of the fund. Depreciation would largely wash that out which would mean that your K1, which is the tax form that we file and give to our investors, your K1 would show either very low, zero, or potentially negative taxable income because of depreciation. So if you're a $100,000 investor, maybe you got $8,000 in distributions in that year pushed into your checking account, but your taxable income is nothing. With that being said, you'll have two issues eventually when the property is sold. You'll have depreciation recapture, which I believe is around 25%. So that's pretty meaningful. And the second one is pretty obvious. You'll have capital gains, whatever those look like years down the road.
So
but in terms of the current hold period, it's very tax advantageous.
And going back to what you said about just the really the value of holding real estate long-term, not actually selling it. That's where the big thing is, because those two tax events, if you don't sell the property, don't actually come.
Yeah, let's before we started the call, we gave ourselves permission to meander. So let's meander for just a moment here. So let's talk about IRR. IRR stands for internal rate of return. And it's the universal metric that is used to gauge the performance of a real estate fund or syndication or a private equity deal or whatever. So it's a time-weighted return based on a series of cash flows. It's almost like an annualized return, but not exactly. So IRR is a very often misunderstood, and I guess not even a word, but misquantified metric. So if someone gives someone like me some money to invest, and I give them their money back plus a little bit of profit, but I do it really, really quickly, their IRR is going to be through the roof. They might have 100% IRR, but they're not happy because they got their money back and they made, $5,000 on a $100,000 investment, and then it's over and they pay taxes. So as you evaluate deals out there, understanding how IRR is driven and what it means is important, but you also want to look at a multiple on your invested capital. And by multiple, I mean, how much profit can you expect to realize over the life of the vehicle as a percentage of what you invested? So in real estate finance, a 1 multiple is a break even, right? You got back your money. A 1.5 multiple is you made a 50% return. So 50,000 on 100. 2 multiple is you made 100 on 100. So if someone can deliver, say, a 2 multiple over 5 years all in, you're probably going to be happy, right? Double your money over 5 years, you're going to be happy.
Yep.
If you get the same multiple over 6 years, you'll probably still be happy, but your time-weighted return is going to be materially less because of that additional year of holding. So in one scenario, you might have a 20% IRR in the 5-year hold, but the second one, I can't really do the math, but maybe it's 17. You're still happy, but if you're looking at deals only through IRR and saying, oh, I'm going to do the 20% IRR deal and not the 17 because it's a higher return. Well, what's driving that return? Are there assumptions that are back-ended with no cash flow between now and year 5, and the sponsor saying they're going to sell it at a 5 cap, and who knows what the world's going to be like then? So kind of blending that multiple component over a rational amount of time with that time-weighted return component is really important.
And I think, something we kind of skipped over was preferred shares inside of these funds, and the fact that you do get paid back without, you get paid back, but then you're also making your return year over year without having any capital invested. So you're redeployed somewhere else, but still benefiting from the upside, and then eventually the sale of the property.
Yeah. More than likely, a complete return of investor capital accounts in our fund will result from a sale or a refinance. It is possible, though, that over time we could generate enough cash flow over maybe 5 or 6 years to substantially return those capital accounts after preferred return. But yeah, once your money's back, whether that's a result of pay down of capital accounts from cash flow or a refinance, once your money's back, you still have the same number of shares in the fund you had originally, and you're still getting distributions. Your capital account is just now 0.
And
That's fantastic.
Do you give your investors the opportunity, the distributions that are coming, to just leave them and continue investing so they effectively pick up additional shares?
We regrettably don't, and I'll give you the reason for that. So there's 2 types of private real estate funds out there. One type is an open-ended fund, which is constantly raising new equity at new valuations and making new acquisitions. And the second type is a closed-ended fund, which is what we are. And a closed-ended fund has a defined period to raise its capital and get it deployed. And once that period is up, the fund closes not operationally, but it closes to new investors and new acquisitions. So because we're a closed-ended fund, we can't reinvest dividends after the fund closes because we're not revaluing that kind of additional capital contribution. So people have to keep their money that we kick out to them, unfortunately, and do whatever they will with it. But it can't go back into the current fund once it closes.
What's your timeline before you open that fund for funding? And part B of that question is, have you ever had a closing that you had to offer a second round?
So we try to raise our capital in conjunction with our acquisitions cadence. And the day that we get those two lined up is going to be never. We either have too much money and not enough deals, or too many deals and not enough money. And then, the next week happens and the pendulum shifts and it's the opposite. So in our fund structure, we'll close our fund with about $38 million in equity by probably mid-December, which is around the corner. And we raise that capital and we time our capital calls to kind of tie in with our acquisitions. So right now we're calling down about, let's see here, about $8 million over the next couple of weeks for closings that are on December 9th and December 15th. Investors wire, and then their funds go into our trust account and they sit there not making a return for about 2 weeks. And then their preferred return accumulation starts on the date of our next acquisition and then fully accumulates from there. So that's how we do our raises. And it's a tough balancing act, timing all those capital calls with a big acquisition that's coming, but somehow we pull it off.
Yeah, that's amazing. That's amazing. That's that is, you got a lot of balls in the air with the fund. That's a lot of work.
Yeah, I mean, and we're mainly just talking about the finance side of it. We're not touching on operations. We have 54 employees, and out of those 54, 40 of those are running our portfolio. So it's very,
wow.
Whatever people might hear about self-storage, oh, it's fire and forget, no tenants, no toilets, no problems. That could not be further from the truth. We are a self-storage operator before we're a real estate investment company. It's very operationally intensive.
That's crazy. That's so much work. And you said, 35 properties currently.
Yeah, 33.
33.
Yeah.
Wow.
And
That
so
is a lot of properties.
Just a side question, just have to ask, since you are in the self-storage business, all these shows you're seeing about the where they're auctioning off the storage stuff, does that actually happen?
So my understanding, I mentioned my partner's parents have a facility in California and they had storage wars out there. And the story goes, they planted some stuff in a unit to make for better TV. So we do.
That doesn't happen, does it?
Yeah, I know. Yeah. Reality TV, you would never guess. You would never guess they would do something like that, but apparently they do. We have not had storage wars in our portfolio. We do run auctions every month. And there's some valuable stuff in there sometimes, but more often than not, it's just a bunch of busted couches and old clothes that nobody wants.
All right. Well, you know what, Jacob, we have not broken at the half hour like we normally do. It's been quite an enthralling conversation. I really enjoyed this. This is it's a great strategy for people who are timid to get into it, also who don't necessarily have the time to manage properties themselves. I think it's more of a passive. Is it completely passive for your investors? Is there or is there some active investing that needs to take place?
No, it's completely passive. And for folks with cash to deploy and they want exposure to the real estate space, I think investing with good managers and good sponsors in a variety of asset classes is a good way to get exposure to that. Most funds and syndications are completely passive. The most work that folks will do is kind of getting to know the sponsor, asking any questions they might have, signing documents, and then from there, people get an ACH payment every quarter. We post tax returns to their investor portal, like a lot of other sponsors do in March. It's fairly passive.
Yeah, that's great. That's great. And then from there, they can let their accountants handle it.
Yeah, that's right. That's right.
So how do folks find you, Jacob?
So they can go to our website, which is vanwestpartners.com, and fill out a form submission and schedule a call, or hit me on LinkedIn, Jacob Vanderslice, or they can email me, Jacob, JACOB @vanwestpartners.com.
Yeah, fantastic. Any parting words you want to share? Any words of wisdom?
The easiest thing to do in real estate is nothing. So go out and do a deal.
Love it. Love it. Well, thank you, Jacob, so much for your time. Certainly appreciate you. Jacob Vanderslice of VanWest Partners in Denver, Colorado. Check them out. This has been a fantastic conversation. Thank you so much. Jonathan, thank you as always for your time as well. Always a pleasure. And thank you for listening. If you have any questions, comments, concerns, you heard Jacob's email in there. You can check them out at vanwestpartners.com. Is that correct? vanwestpartners.com.
You got it.
All right. And if you want more information about us, you can certainly follow us on Spotify. Oh gosh, what are the other ones? Google Play. Spotify is the only one I ever use. Google Play, Amazon, all the major podcasting platforms. As well, you can download our book at investmentpropertyincomebook.com. Again, thank you for listening. Thank you, gentlemen, for your time. Have a fantastic day, and we will see you soon.